Good afternoon or good morning to everyone who joined us, depending on where you're dialing in from. We appreciate you taking the time to join our webinar today. My name is Scott Davis. I'm a director at Provident Healthcare Partners, and I'm going to be the moderator for today's discussion on general dentistry and subspecialized dentistry and the consolidation plays around those various subsectors. We have a terrific set of panelists with us today who I'll introduce in just a moment, but briefly on the firm that I work for at Provident. We are an investment bank. We represent the owners, operators, and investors of healthcare services businesses as they look to liquidate a portion or the majority of their equity ownership and or bring in a strategic partner to help them grow into the future. We spend a vast majority of our time actually in various provider-based businesses, with the dental industry being a major focus of ours in our firm's history. So first, joining for our panelist discussion, we have Craig Woods and Dean Gould from the law firm Dykema. Craig and Dean, thanks for joining.
Hey, guys. Yeah, absolutely. Thank you for having us today. I'll be brief. My name is Craig Woods. Dean Gould is also on the call with me today. I'm a partner in our healthcare M&A group. We focus on healthcare transactions and corporate work, regulatory compliance. We're here at Dykema Gossett. It's a full service firm, over 65 different industry groups and subject matters that we have attorneys that provide expertise on. But in particular, which for the folks on the call today, Dean and I, we spend all of our space or all of our time in the healthcare space, working on corporate matters and M&A matters. We appreciate your time today and look forward to hopefully adding a little bit of wisdom you can take away with you from the call.
Thanks, Craig. And on from the buyer kind of private equity perspective, we've got Scott Ames from BlueSeas Capital. Hey, Scott.
Hey, Scott, how are you? Dean, Craig, nice to see you again. Appreciate everyone attending. Excited to be here and look forward to a great discussion. Just by way of personal introduction, Scott Ames. I'm a principal on the healthcare team at BlueSeas Capital, where I focus on our investing efforts across the healthcare continuum. We like to start with the why at BlueSeas, what gets us out of bed in the morning, and that's supporting entrepreneurs and management teams through growth acceleration, bringing large firm capabilities and resources with a small firm focus and style. In terms of the what, we're a West Palm Beach, Florida-based private equity firm with $750 million in assets under management, and view ourselves as growth-oriented equity investors looking to support high-quality companies serving attractive end markets. 90% of the partnerships we've done historically, we've been the first institutional partner, meaning we have a lot of experience partnering with clinician-led and founded organizations and family-owned businesses. And we'll get into it in a bit, but would humbly submit we've got a great track record within healthcare and dental specifically, having invested in DDS Lab, the largest dental lab serving the corporate DSO market, Decadental, one of the leading de novo focused DSOs nationally, and more recently Beacon Oral Specialists, which today is one of the largest and highest quality oral surgery organizations with over 50 surgeons across 2 key markets.
Great, thanks, Scott. And last but not least, my colleague here at Provident, AJ Shaker.
Thanks, Scott. My name is AJ Shaker. I'm a director with Provident. I spend a lot of my time working with Scott and other members of the team in advising healthcare services companies that are considering some sort of transaction event. Have also done a lot of work in our firm on the dental services arena. I think for us at Provident, we've been advising groups within the DSO space for going on 14 or so years, represented Great Expressions Dental Centers through their first private equity deal with Audax Group. And have really worked with organizations in a number of other practice setups, from multi-specialty groups to single specialty groups, most recently working alongside Scott Ames and team at BlueSeas, representing Atlanta Oral and Facial Surgery through their recap, and ultimately becoming part of the Beacon platform. And so excited to share some insights with our listeners here today, and appreciate the chance to collaborate with Craig and Dean at Dykema and Scott at BlueSeas as well.
Great, thanks everyone. So we'll jump right into the content for today's discussion, with the first topic focusing on the recent consolidation trends within the broader DSO market. Obviously, 2020 was a tumultuous year for the dental industry as well as many other industries. And so let's focus the conversation around what we hope to be a truly post-COVID type of environment and the effects that it's had on that market. So AJ, why don't we start with you and some of the trends that we've seen here at our firm?
Yeah, happy to, Scott. I think what we're seeing today is a really active environment for overall deal-making activity in the DSO sector. And to your point, I think the impact of COVID has certainly played a key role in not only the volume of deals that we're seeing, but also the interest level from both sell side and buy side as far as why to transact now. I think, from, call it that late Q1 to Q2 period, there was definitely a drop off in overall deal activity in the sector as DSOs chose to focus on internal operations, even private equity groups seeking to make sure that their portfolio companies were healthy, could make it through the other side on a solid footing. And so there's a number of groups that came out the other side in a good position and wanted to, from the sell side, continue finding a partner that could achieve personal liquidity needs, resources for growth, and from the private equity perspective, ensuring that they acted on some of their investment objectives in 2020 and almost kind of playing catch up for what they hoped to accomplish last year and enacting that this year. And so there's definitely been a cohort of deal activity that's kind of making up for lost time, if you will. But I think at the same point, we've really seen an opportunity for certain DSOs that, because of their management capabilities, their operational acumen, really came out of COVID with kind of a growth mindset in that there was opportunities to take additional market share from perhaps groups in their area that may have struggled as a result of the pandemic, and possibly serve as a home to independent practices that were able to make it through the pandemic, but wanted to take some chips off the table, perhaps gain additional support for areas like HR, finance, and just kind of strategic positioning that really became a headache for a lot of groups going through things like PPP and furloughs, et cetera. And so I think there's definitely a cohort of groups within the DSO sector today that are really kind of approaching the market as a position of kind of offense, where they see the opportunity to gain significant market share, go into new geographies, and be kind of the preeminent DSO platform investment in the space coming forward, but really want to align with private equity or a strategic DSO in order to gain the resource to make that happen. And so I think coming out of COVID, there's certainly some element of kind of hangover effect, but also a number of groups that kind of came out of COVID in a position of strength and looking to kind of build upon that with a transaction here today.
Yeah, I appreciate that insight, AJ. And Scott, as we think about the private equity industry's continued seemingly interest in the space, how has that changed or been altered by the COVID environment?
Yeah, well, AJ certainly hit all the salient points. So, I'll try not to echo his words too much, but he certainly hit the nail on the head there. What I'd say is we continue to see and have strong interest in partnership with differentiated healthcare platforms, primed for growth and expansion. And for us, the operative word there is differentiated. So in our prior dental investments, across DDS Lab and DECA, truly unique platforms within markets that otherwise have a lot of private equity investment. In the case of DDS Lab, the only scale national vertically integrated dental lab serving the DSO market that took meaningful share through COVID from other labs. With DECA, truly a one-of-a-kind de novo platform that grew from 30 locations when we partnered with them to well over 100 today. That business did extremely well through COVID, really used COVID as an opportunity to get better, to take market share from both DSOs as well as mom and pop dental practices, but also improve the operations of the business in a sustainable way. And then, more recently with Beacon, we really created Beacon during the depths of COVID when not much investment activity was happening. We, viewed it as an opportunity to see through to the other side, to continue to support our existing, but also new investments. and really saw in each of Bay Area oral surgery management and Atlanta oral and facial surgery, which are the two kind of co-platforms that came together to form Beacon. We saw long-term sustainable businesses, a need for the services they were providing, and there was a temporal blip on the demand or the volume side, a sustainable business with good rationale for long-term success, and that in turn gave us really the conviction to move forward through the murky waters at the time.
Yeah, I appreciate that. And I think it's probably welcome to hear on the prospective seller side the thoughtfulness the investor community has around navigating what could be not your average years and performance. There's approaches for all kind of experiences through that time frame. So that's great to hear. And then Craig and Dean on the regulatory front, and even extending this conversation towards the pending kind of tax changes for these prospective sellers and operators. Anything on that front we should highlight?
Yeah, no, I appreciate the question. I think it's funny. Over the last year, I feel like every question I get to deal activity and what we're seeing, so the biggest drivers I think that we're seeing that's kind of like pushing deal activity this year versus next year is obviously the tax situation. I think second is probably fears over kind of the unknown operations a bit, in order to by partnering with someone who may have the capabilities that help them come out on the other side in a better position than what they might have otherwise managed things during COVID. And then really the last thing is just there's been some recent guidance initiatives, talking points, executive orders coming out of the Biden administration with regards to non-competes that I think people are somewhat concerned about. We don't quite know yet where those things are headed, that I think are driving some people maybe to think a little bit about what a deal might look like this year versus next year. I think that what we can tell you about taxes is I don't have a crystal ball. I can't tell you the number's going to come down. Just so we're all saying, taxes we're talking about primarily are capital gains tax rates and the treatment of those capital gains. There had been rumblings, obviously, early in the year that those might tap out as high as 39.6%. What we're seeing now, and I did talk to my tax colleagues here at the firm before the call to see if this was still the case, but what we're seeing now is something that's probably more in line with a 5% increase is kind of what we're predicting at this point. Now, look, if it doesn't go that way at the end of the year, please do not call me and yell at me for where the number ends up being. But everything that we're seeing looks like it's more of a 5% increase. So that's really been the primary driver for everybody. Is that 5% or more or less worth doing a deal this year versus next year? And that's the most common question I get from everybody. And what I tell everybody is that if it's worth it to you to save the 5% and to try to rush a deal through, then maybe it's the right fit. But other people, there are bigger whys that people have to answer. And I can tell you that for a lot of strategics and PE groups out there, they're probably looking for folks that have more motivation for a transaction than just simply, I want to save 5% on my taxes. So I think that's a discussion. It's taxes, it's fears about the unknown with COVID and having a successful partnership with a larger platform that can help them. And then some concerns about maybe some animosity towards healthcare non-competes in the future.
Yeah, I appreciate that, Craig. I probably speak for most people when I say if it ends up being limited to 5%, that's probably a welcome sign considering some of the numbers that have been thrown around, but we won't hold you to that. I should have mentioned off the top, by the way, for our listeners, please do utilize the Q&A function on the top or bottom of your screen. We're going to carve out 10 to 15 minutes at the end of the discussion to hit on those. So send those through, whether it's on this initial topic we covered or the topics to come. But next up, we were going to chat a little bit about the emergence of specialty-focused consolidation. Probably no one better to jump on that first than Scott, given the work that his firm's been doing, specific to oral surgery, but elsewhere as well. Scott, what have you been seeing on that front, and what's driving the interest?
Yeah, appreciate that. And I think, staying focused on dentistry, albeit we like a lot of specialties, we're invested in ophthalmology and continue to like that. But, as it relates to dentistry, and to be clear, we continue to remain very bullish on the overall dental market, including general and the specialty segments. It's an extraordinarily large and resilient market. It's over $130 billion in annual spend, growing at the mid-single digit rates over a very long-term CAGR. And while there's been a lot of consolidation in general dentistry over a couple of decades now, we think there's still plenty of runway for unique models, given DSOs still only represent roughly a quarter of the total market share. I think with that said, we are always looking for new ways to invest within sectors we like. And about 2 years ago, had developed a thematic initiative evaluating the various specialties, the specialty subsectors within dental more broadly. Specifically, we'd identified oral surgery as particularly attractive for a number of reasons. It's a large and growing market, roughly $15 billion of spend annually across 7,500 oral surgeons. And it's extraordinarily fragmented, with the vast majority of practices in groups of a handful or fewer providers. You have a lot of demographic and secular tailwinds, from the population growth to the increasing utilization of implants. And without getting into too much detail, our research suggested, but more importantly, our experience so far has been that there's compelling rationale and receptivity to consolidation amongst oral surgeons, specifically to oral surgeon-led platforms like Beacon. So our thesis was fundamentally predicated on developing an oral surgeon-led organization by building a multi-regional leader of clinical excellence that can help advance the specialty of oral surgery. We're certainly early in the journey, but today Beacon represents already more than 50 oral surgeons across 3 core markets, and we're very excited for the future of the company and the specialty.
Yeah, I appreciate that, Scott. And then AJ, I know in our efforts on the subspecialized front, pretty common feedback we get is on for the specialist, not wanting to necessarily be, mixed in with an army of general practitioners, and hopefully having an outlet for their subspecialized work specifically. What have you been seeing in your efforts in that space?
Yeah, it's a great question and kind of good way to piggyback off of some of the points that Scott Ames brought up in terms of the thesis that BlueSea had in investing into the oral surgery sector in particular. I think for a long period of time, there's really finite options for specialists, whether they be oral surgeons or endodontists in particular, even orthodontics to some degree, as to what sorts of transaction options existed for them. They could kind of have the traditional practice model where they could get bought out by existing partners if they wanted to retire, have their shares acquired by an associate. But while that preserves some of the kind of clinical capabilities in the hands of the specialists, it doesn't necessarily provide much in terms of additional resources to fundamentally grow a practice and achieve some of its growth objectives. And at the same time, there's certain opportunities that did exist for specialists in terms of aligning with, let's say, a general DSO provider. But I think even, going back probably 3-4 years, not a lot of the general DSOs out there necessarily had a specific thesis around incorporating specialty. I think there was a push for groups to think about how best they could best capture referrals, but kind of the jury was out on whether they should just hire those individuals or, potentially acquire platforms to do so. And Scott Davis, I think to your point, some of the concerns that we saw from specialists on aligning, let's say, with the general DSO is, potentially being kind of a black sheep among their GP peers, whether that's perceived or real, and potentially alienating, general dentistry referral sources that may see their new general DSO as a potential competitive force in their market. And so while, there could be access to capital resources, infrastructure for growth, a lot of groups had to balance kind of that pro and con with aligning with, let's say, a general DSO. But I think what we've seen with the emergence of some of the private equity-led consolidators in areas like endodontics, orthodontics, oral surgery, is that for providers in these subspecialties, there's an opportunity to have clinical collaboration with like-minded specialists, the ability to preserve a lot of those existing referral streams, if not cultivate them with best practices that other groups across the country are undertaking, and really benefiting from, specialty-specific technology infrastructure and economies of scale from group purchasing and even payer negotiations and relationships. And so I think if anything else, it's provided kind of a third opportunity for groups to evaluate, and something that, we're having ongoing conversations and hearing from the general DSOs as well, as far as, how they can be, competitive to, partner up with some of these preeminent groups across the country, given Scott's point that, a lot of these subspecialists are, fairly fragmented in nature, and that there's, kind of few quality kind of premium platforms in the market, let's say, compared to their general DSO peers. And so I think it's, a testament to some of the early successes that a lot of the single specialty providers have had, but also something that will continue to be, I think, a point of emphasis for groups as they think about the best ways to incorporate some sort of specialty strategy going forward.
Thanks, AJ. And for the Dykman team, as the pace of this subspecialized consolidation takes off here, what are you seeing now that you're probably getting consistent kind of deal flow on this front? Any kind of nuances to structuring or the like that we should consider here?
Yeah, absolutely. Thank you, Scott. So thankfully, in specialty transactions, largely it's the same as general dentistry. For oral surgery, there's certainly some specific considerations given that there's an overlap between dental and medical, and so sometimes we have to navigate those routes. But overall, in terms of corporate structure and structuring, it's very similar. And so for those on the call that are considering a transaction, it's important to know your current structure and to understand that largely the transaction structure that's going to be played out will be driven by your current tax structure. And so I think it's important for the groups to understand how are you taxed now, how old is your company. If you are a C corp, we have to be mindful of those considerations. And so we tend to find that it's easier when clients come to us and they have an understanding of their current structure if they've talked with their financial advisors already ahead of time. Other important structuring considerations are on the credentialing side. So on the clinical side, some doctors on the specialty side have negotiated very favorable reimbursement rates, and obviously folks like Scott want to make sure that they continue to receive the benefit of those reimbursement rates. And so how do we continue to operate that clinical entity, continue to bill out of that, but at the same time affiliate into a DSO structure? With specialties, we also have to be mindful of some of the anti-kickback considerations, given that there are cross referrals. And so anytime a group comes to us with a specialty platform, we want to make sure that we're understanding how revenue flows within the platform to ensure that there's no anti-kickback issues that we need to work through a diligence process. And then, with any transaction, governance of the seller of the practice is important. We want to make sure that all the players are aware of what's going on. We want to make sure that we're aware of every side agreement that's been made with particular providers, so that we can go into the transaction knowing who is, owed a portion of the purchase price, what we need to document, paper up that wasn't papered up. It was just an understanding between the parties. And so I think it's important for sellers to make sure that all their governance documents are in order and all the agreements they've made with specific people in their organization are documented.
Thanks, Dean. And throughout this discussion, we've at least alluded to the different types of partners that could be out there for prospective sellers. As we think about the different high-level options, being a private equity platform, joining forces with a private equity-backed DSO of regional or national scale, and then lastly, just joining another privately held business, whether that's just to combat the private equity-backed community and the growth that it has, or to position itself for longer-term consideration of running such a deal. Why don't we dive into all of those different options? Starting with the PE side, Scott, what are you looking for in an asset there, and kind of what's the prospective sell from your perspective?
Yeah, thank you. I guess I'd start by saying that we don't really think there are any right or wrong choices. The choice to be a platform or part of a larger organization is one that depends on your existing practice group profile and your future goals. In both cases, we'd humbly submit that considering a partnership or transaction is oftentimes a way of quote unquote splitting your aces. where you get to take some chips off the table, but also remain a meaningful owner going forward, which is important to us, all while getting the business and capital to support to accelerate the growth of what would have otherwise been possible doing it on your own. I think to answer your question specifically, Scott, about what are some of the things we look for in a platform, that include local market leadership. And that means not just size for us, but also clinical reputation amongst both peers as well as patients. We look for reasonable provider and payer diversification. Perhaps most importantly, we're very focused on strong future alignment between the doctors and the investors. And that would also include a path to ownership for both existing as well as future associate providers. So while it's important to maintain alignment amongst the ownership group or the partners of the practice, the associates are really the lifeblood of the next generation to ensure that there's a sustainable platform and business for many years to come and not just the near term. And then lastly, while we certainly don't expect a fully built out PE platform from a lot of our clinician-owned businesses, we do look for some level of reasonable corporate infrastructure as a backbone that we can use to support additional investment for growth. That's one of the things we loved about AOFS that we worked on with the Provident team, and that is a consistency that we look for among our other platforms.
Thanks, Scott. And then AJ, any thoughts you have on the regional and national DSO population as well?
Yeah, happy to talk through some of those options. And I think, from the perspective of those national and regional DSOs, a lot of them are backed by private equity already. So to Scott's point, there may be kind of similarities in terms of the overall structuring in order to ensure alignment between the clinicians, the management team, the private equity fund, and the DSO that's doing the consolidating. Most often they'll look for some level of cash at close that goes to the shareholders, but also rollover equity to ensure that alignment of interests. And I think what's interesting with a lot of the DSO options in the market today is that there's been differentiation in terms of how groups think about the treatment of that rollover. Some groups prefer to have that rollover sitting in the top level entity where ownership can be shared and value can be created across a number of different organizations, perhaps across specialties, but especially across geographies. And other organizations take the mindset that it's kind of more important for rollover equity to be held at almost a local level where the providers, the clinicians, the management team can see kind of the fruits of their own labors in partnership with a fund or with a larger DSO to get, essentially income repair of what they, sold down to fund the initial transaction, recouping that over time by access to additional distributions as time goes on. I think, there's certainly kind of pros and cons to each. And to, I think, Scott Ames' point, it's important to consider all potential options to see what's kind of best for you. But I think in addition to what, the private equity option offers, I think what you'll see from a lot of the DSOs out there is that, there's some ability to kind of pitch your wagon to a proven concept. You may not necessarily have to create, the national level platform infrastructure from scratch. You may be able to attach your rollover equity to a concept that's already grown in value. And while most private equity firms have kind of a time horizon of call it, 3 to maybe 5 or 7 years in terms of their hold cycle, groups that, let's say, align with a regional DSO or a national DSO may actually be able to see that second bite of the apple event a little bit sooner, especially if they're in, call it year 3 or 4 of the hold cycle. And so that can be an important element to consider for, potential sellers in these transactions is, what level of infrastructure may I be able to, realize the benefits of day one in partnership with the DSO? What sort of value and kind of the timeline of harnessing that value can exist with this type of partnership? And I think at the end of the day, what we're seeing, especially for kind of sizable regional platforms, is that there can be both options, private equity and kind of DSO in nature. And from the DSO perspective, I think there's definitely a mindset of several groups that, while they can do kind of onesie, twosie acquisitions that can be very accretive, it takes a lot of them to, let's say, get to the same level of size and scale as a significant regional platform. And especially that regional platform could offer some kind of unique opportunities to unlock new geographies and perhaps even augment the overall management team. So I think at the end of the day, it's definitely been kind of a competitive environment among, private equity sponsors as well as existing DSOs, regional DSOs, given that, there's kind of a select grouping of those kind of mid-level providers that really could fit the bill for either option.
Great. And then for the last category, we had the non-private equity backed DSOs. It's our understanding the Dykeman team's assisted in some capacity for groups positioning, potentially for a private equity deal down the road, or just simply with the mind towards remaining privately held. Craig, what can you tell us about your work on that capacity?
Yeah, I mean, we still have people come to us that have non-PE backed platforms that are looking for assistance there. But I'll tell you, 5 years ago, I think there were ample opportunities for those. And I think nowadays, those opportunities are much fewer and far between than what they were before. AJ spoke to this, where he was talking about kind of PE-backed national platforms and then regional platforms. And what we're seeing is that a lot of the groups that were regional platforms are now PE backed and now are expanding and growing. And so they're out there. I just don't see as many opportunities for those unless you're an entrepreneurial doctor or dentist who's looking to kind of organically grow your own platform. Maybe you've got a network of folks and you think that it would be worth it to go it alone, so to speak, at this point in your life cycle. And so we've infrastructure in place to understand the regulatory environment, to make sure that they have a structure that works today and works to bring on in future investment, and then for a potential exit strategy down the road. But I will be honest, I think that those opportunities are more rare than what we saw 5 years ago. The other thing I would say on that too is that, when we were talking about this kind of to prepare for the call, Scott, one of the ways that we discussed this question was, it was in the context of maybe entrepreneurial providers who are looking for a little bit more autonomy in their operations, and maybe the autonomy goes away. And I just want to reiterate for everybody that I think that it just depends on the group. And I think that's why it's so important to make sure you pick the right advisors to work with that can help you, that can help educate you on the different groups that are out there. Because most of the groups that we work with, and Dean and I work on the sell side, and we work with a lot of very large PE-backed platforms, and all of them are different. And you have a regulatory construct that limits the ability to really get involved on the clinical operations of the practice. So you already have that level of protection. But then I would also tell you as well is that some of the best PE partnerships that I have seen are those where the sponsor is really truly looking to the providers to manage their practice and to grow their practice, and they really are, it's really truly a partnership. So I don't think at the end of the day that just because private equity is involved that you're now going to lose your sense of independence or autonomy. I do think there might be some groups out there that could perhaps be the case, and there's been more PE involvement. I think you're seeing a number of these groups where they'll tell you, and it may be people on this call today that will tell you, I did a transaction, private equity is involved, and you know what, not a ton has changed in a good way about how I operate, but I now have a partner that I can go to and talk to whenever I have an issue like, I don't know, like a pandemic that you need to work through. So that's our experience at Dykeman.
I think you nailed it, Craig. You couldn't have said it better. We have a saying around here that we love to partner with great clinicians who are also good business people. We're not looking to break something or fix something that's not broken. And, to the clinical point, in a lot of our businesses, we've actually set up clinical governance boards that are comprised only of clinicians, not the business people. Certain management team members sit on those boards more as, secretary note takers to ensure ideas turn into action more than anything else. And it really is a great way for clinicians who may have otherwise only been part of a small group practice to collaborate with KOLs across the industry, across the nation. Yeah,
well said. Appreciate that, guys. And one thing that's very typical that we hear, in our efforts here on Providence side, from our prospective clients is, what are the key attributes that potential investors are looking for in a business. What should we be good at? What should we be improving at? How should we position ourselves? And so starting with the Dykema team, what would you advise for prospective sellers from potentially a structuring or management structure that would be well received within the market?
Yeah, I think it's important to incentivize your providers. Though, as Scott Ames said earlier, they're the lifeblood of these organizations. And so maintaining talent in this market is just critical. And so that can happen prior to an affiliation with a DSO or after, right? So prior to, finding ways to incentivize your associates to remain and to grow the business in anticipation of affiliating. That can be done through phantom equity, profits interest, stay on bonuses, any type of way of monetarily incentivizing the associate to remain. And when you're only a practice, the regulatory concerns aren't as strong because they're only at the clinical level. But even post affiliation, when a group like Scott Ames comes in, BlueSeas Capital, how do we continue to incentivize those associates to want to stay? And so what we're seeing a lot more is even the doctors that weren't involved in the sale, that are just purely associates, they will have the opportunity to come in and purchase some of the equity in that holding company, or as AJ was saying, and sometimes in the joint venture, and that keeps them incentivized. We see other incentives built into the employment agreements that are bonus driven. And so I think just finding ways to ensure that you can keep the human capital, because that's the lifeblood of this business, happy, incentivized, and staying, because there are other opportunities out there right now for doctors. And so, ensuring that they're regulatory compliant once you've affiliated with a DSO, and, ensuring that anti-kickback and Stark issues have been analyzed. And that's something that we have a team over here at Dykema that can handle. And then just making sure that those associates are happy. I think that's absolutely critical.
Yep, well said. And AJ, as we think about the back office infrastructure of these businesses, I think more often than not, we're advising folks to invest on that side, certainly, as there's some level of requirement from the investment side that they're expecting to be in place, but also being mindful of remaining efficient and using your dollars wisely to develop your business. What advice would you give on that front?
Yeah, absolutely. And I think this kind of mirrors what Scott Ames mentioned earlier, where I think there's some level of expectation if you're going to be either a PE platform in its own right or a significant regional platform, that there's some level of kind of scalable infrastructure that's needed that a potential partner can build off of and augment to kind of supplement the overall growth of the business. And I think that kind of comes part and parcel with being prepared to run a transaction process. There's a lot of diligence requests, data that's needed in order to navigate that process successfully from start to finish. So essentially having that operational infrastructure that can harness, clinic level KPIs, enterprise level KPIs, financial reporting across the entire organization, but that may also be able to be cut through various site level dynamics as well is important. And I think, laying the base layer of kind of those support services that are ultimately what drives patient retention as well as provider retention. So whether that be laying the groundwork for, let's say call center that can help on recall rates, reappointment rates, billing and collections that can help augment kind of the productivity-based model that associates or partner dentists receive in these businesses, are all kind of important elements to scalable DSO operations, and kind of excites folks like Scott about partnering with a business and, let's say, allocating more of their time and efforts towards growth rather than needing to build all those systems from scratch. But I think at the same time, it's important to consider that most, PE investors that are aiming at kind of the lower middle market of DSOs and healthcare services more broadly, understand that, not every business is going to be built to the exact specifications of what a middle market PE fund wants. It's really kind of a collaborative approach. And at the end of the day, it's kind of a common theme that even Craig and Dean brought up earlier. A lot of these transactions are, where, funds are essentially backing people. These are service-based businesses. And so having kind of that management team and, clinical body that not only understands the dynamics of how best to kind of recruit and retain, key constituents in the business, leveraging that infrastructure is important, but also, backing a team that has that kind of local market knowledge in order to identify where de novos can be successful and how they can selectively layer in acquisitions as well that could help kind of supplement the overall growth path of the business.
Yeah, I really appreciate the insight from both the Dykman team and AJ on how best to position the business in terms of today's stance and what you need to do historically. But thinking on a go-forward basis, Scott, what commentary would you provide on kind of the growth opportunities that would ideally be in place that you look for and your potential partners?
No, great question. And I mean, I think, assuming for purposes of the discussion that we're looking at platforms, we really look to take a bespoke approach to each business and each market. For example, in the case of DECA, where we invested, 5 or 6 years ago at this point, we partnered with 3 founding dentists. They had grown the business organically through de novos from 1 to roughly 30 locations at the time we partnered with them. We helped them accelerate that growth largely through de novos to well over 100 locations today. We did a few tuck-in acquisitions as key beachheads in new geographies, from which we then built out additional de novos. And so that's in a general dentistry market that has largely been grown through M&A, but where DECA was, a one-of-a-kind de novo focused model. And the shift into oral surgery and our investment in Beacon Oral Specialists, we recognize that given the supply-demand dynamic with the providers, M&A is more than likely to be the predominant growth lever there, but with an opportunity to build out additional offices and hire providers organically. And that's something that one of our 2 foundational practices, AOFS, had done successfully over time. They had grown roughly 50-50 through small practice acquisitions as well as de novos. So we do look for multiple levers, and then most importantly, the sum has to be greater than the parts for us. So we do focus on building in a contiguous way, building density within our key geographies, either starting with or having a path to become a market leader so that you get the benefits of scale on payer contracting, on suppliers or vendors, on labor utilization, those types of things.
Appreciate that, Scott. And now for a topic that's certainly top of mind on both the buy and sell side, valuation. AJ, starting with you, what have you seen since particularly the pre-COVID era, effects on valuation, appetite for transactions, both on the buy and sell side? What have been the trends on that front from your perspective?
Yeah, it's a great question and one that we get asked all the time. I think, a key indicator of the valuation environment is just competition over transactions. And I think we've seen the market be as competitive as it's ever been, both in terms of funds that are eager to back new DSO platforms, but also just the 80 plus some odd just general dentistry type consolidators out there that are backed by private equity, all looking to kind of compete with one another for sizable either bolt-on opportunities or beachheads into new geographies. And so I think a key theme that we've continued to see in transactions as of recently is transactions that have been structured in such a way to essentially augment the financial profile of the business related to COVID, either shutdown related dynamics or abilities to kind of gain valuations that are comparable to, let's say, pre-COVID levels for organizations that are still on the upswing. I think the groups, especially as we move through the next few quarters, that are going to continue seeing the most level of interest and kind of gaining those premium valuations out there are ones that can demonstrate that they've kind of put a lot of the COVID hiccups behind them and are showing continued track records towards not only achieving pre-COVID growth targets, but also essentially trending towards where they were projecting for 2021 and beyond. I think at the end of the day, while valuation multiples, especially for the platforms, have been as high as they were pre-COVID, and comparable with other areas of healthcare services, there's still kind of a number of diligence check boxes that need to be addressed in order to achieve those multiples that you hear of and call it that double-digit time frame, where having that kind of demonstrated growth track record in the past, but having growth opportunity ahead having scalable infrastructure that can meet the demands of the business going forward, but also alignment among the management team, the clinicians, to essentially serve as that kind of operational piece to address that growth, are all kind of key drivers of obtaining those premium valuations that are still out there in the market today.
Yeah, and AJ, to your point, we're seeing that competition really extend down to the add-on tuck-in type of acquisitions as well, which do nothing but drive value conceivably. The Dykema team, as you've noted, you work with some of the larger DSOs in the country and undoubtedly work on a lot of those such tuck-in transactions. But what are you seeing from a competition perspective at that level of transaction?
Yeah, no, thanks for that, Scott. I mean, we have a lot of clients in this space, in the dental space in particular. And, again, 5 years ago, most of that was general dentistry. And then you start looking and specialty has become extremely hot. Everybody is looking to differentiate. And it seems that the specialty space has been one of those drivers for everyone. The competition has increased. There's a new player, it seems like every minute, not every day in the space. We just had our conference in Denver, a few weeks ago, and, we had over 1,000 people there, and many of them were people that we had not met until the conference. And I think that's indicative of just the number of people that are starting to get involved, in the space. And so, so when we look at what that is, what has occurred, the demand, I think, is there. Obviously, that's caused prices to increase. You're finding that, especially for folks that are coming along, and kind of making their first platform investment, that you're starting to see those numbers really over the last 18 months, they continue to go up. I think one of the other things that's been a key driver of that as well, some of it's been kind of geography. Obviously because of the impact of COVID, you had some areas that were a little bit more open than others. And so some of the numbers that you're seeing in certain areas, that's also kind of impacted the prices that are being paid and thrown around by folks. So that's obviously had an impact. And then as well, early on in the discussion, Scott Ames kind of looking to grow through acquisition, have kind of circled the wagons, kind of looked internally, seeing how they can kind of work on themselves, so to speak. As a result of that, you've had some groups that have come out really well during the pandemic. You have others that may have not come out quite as well, as there to be maybe an increased demand for certain types of businesses out there, ones that have been able to, I think, manage the pandemic in a way that has allowed them to continue to operate in some capacity and to provide value to patients moving forward. So I think all of those things have had an impact, obviously, on pricing. But yes, I mean, in general, it has been somewhat of a seller's market over the last 18 months. I don't know if I would have predicted that back in March of 2020, but given kind of the deal flow that we've seen here at Dykema, that has certainly been the case.
I appreciate that, Craig. And Scott, as we think about things from a specialty perspective, I know one common question we get when speaking to the specialty folks is, should we expect a similar valuation, less or greater, similar as to the general dentistry population? How do you think about that?
Yeah, it's a good question. I mean, I'd say it depends, and not to completely punt, but it all falls on the continuum. I think all else equal, specialty is as attractive as dental for a number of reasons. But you've got to juxtapose it to what does the provider base look like? What does the payer base look like? What does the historical and future growth opportunity look like? And then most importantly for us, I'll continue to go back to this, is just the alignment with the clinicians. What is their outlook in terms of practice trajectory? What is their rollover? How are we going to recruit and retain both existing as well as future associates? And I think if you check all those boxes and you have the infrastructure to really be a platform, then absolutely, specialty practices are commanding multiples commensurate with what you've historically seen on the general side. But on the same token, we don't view every practice with 5 or 8 providers as a platform. And so one of the things that we really liked about oral surgery in particular, and that I noted earlier, was the level of fragmentation, where we believe that there's not much room for many or any more true platforms, and that there's certainly the possibility to bring a number of smaller practices together to create one. But there's at least more of a rate limiting factor there than maybe what you've seen in some other provider specialties like ophthalmology, GI, orthopedics, et cetera.
Appreciate that. And we'll move quickly through these last 2 topics. We've got 1 or 2 follow-up questions from the crowd that we'll get to. But in terms of positioning for a potential transaction, would love to get perspective from each of the parties we have on the panel here. Legally speaking, Dykema team, what should be kept in mind for a group that's looking to run a transaction on the nearer term?
Yeah, no, I appreciate the question. We get that a lot. Unfortunately, a lot of times we get the question after the process is already started. And so a lot of the planning is kind of gone out the window at that point. But look, in a perfect world, if someone came to me early on and said, what can we be doing now in order to prepare for a transaction 6 months to a year down the road? I'd say there's really kind of 3 general categories, and Dean can speak to a little bit of this as well. First of all, I'd say you need to go and you need to be prepared. You needed agreements and your other key documents that you prepared 10 years ago without any thought towards a future transaction, because those documents now are going to be viewed through a much different lens than they were when they were created many years ago when you were first starting your company. Second is you need to start building your team. And when I say your team, I mean your advisors. That's legal, and that's also financial. That's also your CPAs. Oftentimes we get questions around financial questions from our clients that frankly, you do not want a law firm giving you input on. If you're asking me to tell you if your EBITDA is the right number, you've gone to the wrong place. So having the right financial advisors on board is key. And then I think the third thing from my perspective is simply know who your key providers are in your company, and make sure that they're people that wait till the last minute to do that. We have many stories where we got to close or almost to closing, and a key person caused problems for a transaction for many different reasons. And so I would say knowing who those people are and having a plan in place for them, I think, is incredibly important. And then Dean, I know you have some perspective on the diligence side. I know you get to dig through a lot of documents and other things, and so you've kind of seen things from your perspective. So why don't you give a couple of points on that?
Sure, and AJ touched on this as well. Throughout the process, you're going to be asked to provide a number of documents, and you may not have looked at these documents, as Craig said, in 10 or so years. And so I think one of the key things to prepare for is just to get organized. Have somebody help you, an office manager or something, get all the documents you think are relevant to your business into some sort of electronic folder. Go and take all the paper files and get those copied, because eventually somebody's going to ask for them. And so to have them ready to go will help make the process more efficient, will relieve some stress from you, because the diligence process is not fun, but it's necessary from Scott Ames's perspective on the buy side. He wants to make sure he knows what he's buying. And so for the sellers, it's just, if you're organized and ready to go, it just makes the process a whole lot easier. So that would be the best advice I can give for a prospective seller.
And Scott, if you wouldn't mind providing your perspective from the private equity angle.
Hire good legal counsel. So I not even joking, but seriously, they say the most expensive lawyer is a bad one. I mean, it is important to hire good legal counsel, folks who have done it before, like Dean, Craig, and their team. So we've been through them all, and certainly suggest that. Beyond that, I mean, for us, and in all seriousness, it's very important for a partnership group to give good long thought to what they're looking for. What does the practice trajectory of the doctor group and individually look like? We don't expect every doctor to, work till the day they die, but we do want to ensure that we are creating a sustainable environment and an enterprise that can last the test of time. And we want to ensure that we're creating an environment where we can successfully recruit and retain the next generation of providers to help support the business and to help ensure that there's a good transition for physician retirement. So a little bit nebulous, but an important one where just really good alignment up front. We'd rather have the transparent conversation and step away if there's not good alignment than shake hands and find out that there isn't that type of alignment further down the process.
Thanks, Scott. And AJ, from the investment banker side?
Yeah, I think Dean, Craig, and Scott covered a lot of the points that came to mind for me. I think maybe just to reemphasize the point that Scott just brought up, just making sure that there's kind of foresight in terms of what a deal could mean for all the important constituents of the business, whether it be the management team, the shareholders of the business, even kind of the rank and file employees, and ensuring that there's a methodology to ensuring that those individuals can still benefit from an overall transaction and not just kind of a small cohort of, let's say, the shareholders who get, the economic upside of doing something. That's, an aspect of a deal in terms of why you're doing it and what's the impact of the business that maybe isn't necessarily apparent to a lot of individuals that, kind of see the dollar signs out there and kind of the excitement of M&A deal making. And so at the end of the day, it's kind of part and parcel of what Scott just mentioned, just being reflective and kind of considerate of, what a deal could truly mean for kind of the business objectives, but also the key constituents as well.
Appreciate that. And for our last topic here, just kind of concluding thoughts around any potential changes that may happen in the market. Obviously, no guarantees around this, but would love to hear from each participant today, kind of quick thought on where the market's going from your perspective and trends that you're tracking. Why don't we start with Scott, if you wouldn't mind kicking us off?
Sure. A bit self-serving, but I think there will be continued consolidation among the specialty markets. I think they're very good case studies across a number of physician and dental platforms at this point in time, but particularly where there's good rationale and substance to the consolidation, where the practices are integrated to single PMEMR, where there's benefits of scale with the payers, with the vendors, to create a sum that is greater than the parts, where there's benefit to all of the stakeholders, including the providers, the employees, and the investors. So we're very bullish on dental and on healthcare consolidation more broadly.
Great. Any other thoughts from the Dykema team on that front?
I wish I could say anything different than Scott. Again, it probably seems a little self-serving being an attorney and on the M&A side here, but yeah, I mean, everything we continue to see is that consolidation is going to continue to proceed at a rapid pace. Specialty is going to continue to be a hot topic, multi-specialty, as well. And I, at least from what we can see and the phone calls we field, in the near term, we don't really see any slowdown in sight. I would imagine that, given, depending on what happens with the tax rate, you could see some temporary changes while folks, get together and try to get creative a bit, about how to address changes in the tax paradigm. But for the most part, we are projecting, rapid growth and continued investment throughout the year and into next. And at least that's how we're proceeding to hire folks into the firm. So we certainly anticipate a lot of work to do over the next 18 months at least.
Thanks, Craig. And AJ, any closing thoughts?
Yeah, I think just, what we've seen over the last, year, 2 years or so is that, private equity and consolidation trends in dental are just here to stay, and they're going to continue evolving in a number of ways and shapes. I think probably most important is around continued differentiation in terms of deal structure that can enable some of that collaborative effort between management teams and stakeholders, providers, and the PE funds. And so I think, I would encourage, and I know, all of us at Provident and even on the webinar encourage, our clients and the folks that we interact with in the DSO world to, just continue getting educated around what's happening in the market, ensuring that they're thoughtful around what a transaction could potentially mean for them. And maybe self-servingly for myself and Scott and Dean and Craig anyway, continuing to talk with the right advisors to get kind of good perspectives on the market to judge, when and if the right time is to do something in terms of a transaction event.
Thanks, AJ. And it looks like we're a couple of minutes past the end of the hour here, so appreciate those who have hung in here with us. Thank you to the panelists for the time and thoughts today, and certainly to the listeners for checking in. Apologies for not getting to the one or two follow-up questions. There was just a lot of good content to cover here, and I think it was worth doing so. So we at the Provident side will follow up directly with those folks who sent us some Q&A items, and we also will be looping back with a recording of this webinar. You can share with your colleagues and friends or give another listen yourself. So all the contact information for the panelists will be in that outreach, so feel free to reach out directly with any other questions. But thank you again for your time, and hope to speak with you soon. Thanks.